Happy Friday, everyone. How's everybody doing? Got a lot of people missing for various personal reasons, which is fine. But I've been trying really hard to keep my energy and enthusiasm level up, and I think it's one of those Fridays that everybody's just kind of tired and wants a little bit of a rest. I was giving my graduate students grief in my early class. This is a 9:30 a.m. class, and I was throwing questions at them, and I was not getting much responsiveness. And usually at the graduate level, they're pretty good about when I ask questions, just kind of like nodding or something like this. And it was just like nothing. And I think I got to the bottom of it. I think the letters AYCD were involved. Yeah, that was the suspicion I have, and this was news to my innocent ears. But yeah, and then my AIS class, they actually did pretty good when we were Excel, because Excel was exciting. But then we were doing some AI stuff, and I told a joke and nobody laughed. I did hear somebody, I think, maybe mutter the words "Okay, boomer," and but I probably deserved that. I probably deserved it. So yeah, we're gonna try to keep the enthusiasm level up, but I realize that everybody's kind of looking forward to the weekend, and that's cool. I hope you guys. I know you guys probably have a lot on your agenda, but I hope you get a little bit of rest, a little bit of relaxation. Do not overindulge in this whole AYCD thing that I've heard about. I've heard that can be hazardous. All right, so let's go ahead and let's kick off. Let's talk about our homework, starting with the multiple choice. So the existence of audit risk is recognized by the statement in the auditor standard report that the auditor, now this is something we alluded to at the very beginning. We talked about audit risk. Why does audit risk exist? What are the two words that characterize the existence of audit risk? What two words should you be looking for? Not absolute assurance, but
Inherent.
Reasonable assurance. Reasonable assurance. Okay, because remember, reasonable assurance says we can do our job to the best of our ability, and still there can be a problem. Okay, so we're looking for reasonable assurance. Now, do any of these answers contain the phrase reasonable assurance? That's probably our correct answer. So let's read it. Obtain reasonable assurance about whether the financial statements are free from material misstatement. Yes, that's what audit risk is representative of. Okay, let's just go through the other answers just to make sure that we're clear on this. Okay, audit risk, does it assess the accounting principles used to evaluate the overall financial statement presentation? That's done in the audit report, but that's not the nature of audit risk. Realize that some matters, either individually or in the aggregate, are important while other matters are not. Okay. No, audit risk is not trying to characterize what the nature of different types of risks are. It's just trying to say that audit risk exists. It's responsible for expressing an opinion on financial statements, which are the responsibility of management. That is true, a true statement, but that's not true of audit risk specifically. So the statement in the standards audit report about audit risk is recognized by that reasonable assurance statement. So important to remember. All right, a little bit easier question here. Risk material misstatement refers to a combination of which two components of the audit risk model. So we know that risks exist in an organization by virtue of the fact that an organization goes into business. What do we call that? Inherent risk. Okay, and then responses to risk are going to be put into place. We know that those exist, but those responses may not necessarily be effective. What do we call that concept? Control risk. And so those are the two components. That's inherent risk and control risk, which is C. All right. As lower acceptable levels of both audit risk and materiality established, the auditor should plan more work on individual accounts to find what. So obviously they're going to find errors. So it's going to be A or B. The question is, are they finding smaller errors or large errors? Now think about this. We've talked about this concept already. Would other things being equal, would we rather have our risk levels be high, or would rather be low with respect to like this concept of audit risk? Think about this. If you set your risk levels at really, really low, that means you can only tolerate a certain amount of risk. So the lower you set your audit risk levels, the more work you have to do. So you'd rather be set at high. Now, speaking for audit risk, we can't really set that feasibly at a high level. It has to be low or very low. It's effectively a constant, but intuitively, we don't want that to be the case. Same thing for materiality. You want materiality to be a large number or a small number? We talked about this in chapter 3. What do we prefer? We'd rather materiality be as large as possible, because the larger it is, the less work we have to do. What is the intuition behind that? Well, if we're doing more work, we're trying to identify more minuscule details. Okay. The way that I would rephrase that is saying we're trying to find smaller errors. All right. When we make risk lower, when we make materiality lower, we're putting ourselves in the position that we have to do more testing because we have to find more small errors. We have to actually be more certain that our assertions are, sorry, our assessments are correct. All right. 417, which of the following characteristics most likely would heighten an auditor's concern about the risk of intentional manipulation of the financial statements? Has anybody in this room even started looking at CPA exam questions and like types of things you'd see on the CPA exam? If you're planning on taking the CPA exam, trust me when I say you will get sick of those words most likely very, very quickly. You're probably going to get sick of them in this course as well, but they like to use those words most likely. And so, yeah, that's basically trying to say it's not the right answer, but what's the most correct answer, and it just gets very, very sick. So which of the questions would be would most likely heighten auditor's concern about the risk of intentional manipulation of the financial statement? So what's going to perk up our ears and say, I think there may be a chance of fraud or a higher chance of fraud. So let's go through these, all right? Turnover of senior accounting personnel is low. Now, if fraud is occurring at an organization, do we think turnover would be low? Traditionally speaking, I would say that if fraud is occurring, that's probably not a pleasant place to work, and turnover would be high, okay? So it's probably the opposite direction. Insiders recently purchased additional shares of entity stock. All right, think about it. If fraud is occurring, the insiders probably know fraud is occurring. And it's very unlikely they're going to say, our organization is performing great. They're going to know, yeah, fraud's going on. This is a sinking ship. If you're on a sinking ship, are you wanting to go further underneath the ship and get more ingrained, or you want to get off that ship? Probably get off the ship. They probably would sell their stock, not buy more stock. Okay. So these two are probably strong indicators that fraud is not occurring. Management places substantial emphasis on meeting earnings projections. Ooh, that sounds nefarious. What do we call that from the fraud triangle perspective? Sounds like a pressure. It sounds like a pressure. Yeah, definitely pressure. Okay. So we could say that's probably our answer, but let's look at the last one. Rate and change of the entity's industry is slow. Okay. We know that ever-changing industries, high-changing industries, those tend to contribute to risk. If its change is slow, that's probably less risk, which means that we probably have less risk of fraud in that scenario. So C seems to be our clear answer here, as the other ones don't make sense. All right. I gave you some interesting or some basic questions. I think you probably get these. So which of the following is a misappropriation of assets? What's another word for misappropriation of assets, by the way? Theft. Okay, so we're looking for what's a theft. Classifying inventory held for resale as supplies. That's not a misappropriation of assets. That is kind of a fraud. It's really more of an earnings misstatement. It's a misclassification. Investing cash and earning at a 3% rate of return as opposed to paying off a loan with an interest rate of 7%. That's just bad idea, but that's not theft. An employer of a consumer electronics store steals 12 CD players. What do you guys think? Is stealing theft? Sure sounds like it. Yeah, so that's going to be the case. Management estimates bad debt expense of 2% of sales, what actually expects bad debt expense to be 10% of sales. So that's not necessarily fraud, but it's definitely dishonest. Okay. You might say that that would equate to financial statement fraud, but it would not be misappropriation of assets. I think you can make an argument this would be financial statement fraud, especially if there's not a good faith representation of bad debt expense. Although bad debt expense is 10% of sales, what business are you operating in if that's the case? Darn you, accrual-based accounting? Goodness gracious. Yeah. All right. Then moving on to 420, which of the following is an example of fraudulent financial reporting. So fraudulent financial reporting is kind of the counterpoint. That's where we say that they're deliberately misrepresenting the financial position of the organization. So company management falsifies the inventory count, thereby overstating inventory and overstating cost of sales. So it's inventory. So obviously this has to be theft, right? Right? I didn't catch you guys. You guys were on top of that one. This is a financial statement misrepresentation. This is not theft of inventory. This is misrepresenting inventory. Okay. So you overstate ending inventory. That basically makes cost of goods sold lower. What does that do when you make cost of goods sold lower? What does that do to the bottom line? Makes the bottom line go up because you subtract that from sales revenue to achieve income. So, or at least gross profit, which flows into income. So yeah, you make cost of goods sold lower, you make the bottom line go higher. Let's just go through the other ones just for context. An employee diverts customer payments for his personal use, concealing his actions by debiting expense account, thus overstating expenses. So diverting customer payments for personal use. That sounds like taking cash and putting it in your pocket. That sounds like a theft of assets. An employee steals inventory. I don't really need to read beyond that, do I? Okay. Employee borrows small tools from the company and neglects to return them. The cost is reported as a miscellaneous operating expense. That's a question of whether that's a fraud, because the fraud usually requires intent, but even then, that would still be classified as a misappropriation of assets. All right, last multiple choice question. Which of the following is correct concerning auditor communications about fraud? All right. So I don't really, you guys know I don't like questions like this because you have to read through all the answers. So let's just go ahead and go through them. Fraud that involves senior management should be reported directly by the auditor to the audit committee, regardless of the amount involved. What do you guys think about that statement? Does that sound consistent with what your expectation would be? I like that answer. I like that answer, but let's go through the rest just in case. Fraud of the material effect on the financial statements reported directly by the auditor to the Securities and Exchange Commission. All right, is that something we talked about? We didn't really talk about reporting to the Securities and Exchange Commission. There will be scenarios where that's the case, but usually those are much, much bigger scenarios than just a fraud with a material effect. Any requirement to disclose fraud outside the entity's responsibility of management and not that of the auditor. We didn't really specifically talk about that, but does that sound reasonable? It really depends on the nature of the fraud. Okay. We don't really know what the nature of the fraud is. If we're talking about stealing packs of gum, management doesn't have a responsibility to disclose something that would not be material to stakeholders. So that's not necessarily true. The professional managers provide no requirements related to communication of fraud, but the auditor should use professional judgment in determining communication responsibilities. That is not true. We have talked about that. We said illegal acts, the auditor has a responsibility to determine if it has a direct and material effect and must communicate that to the appropriate channels. Okay. So we have talked about both of those. So A is our answer. That's the one that makes most sense here. All right. Question number 428. Or problem 428. All right. For each of the following situations, explain how risk and material misstatement should be assessed and what effect the assessment will have on detection risk. Now, I approach this particular problem differently because the way the book associates this is they just want you to assess risk and material misstatement. What I'd like to do is I'd like to assess both components of risk and material misstatement. So I like to assess inherent risk and control risk. The interesting thing is we may not have clear detail on each of these, so we may have to make some assumptions in assessing both of these components. But I think this will be a valuable activity in doing so. Johnson Corporation Incorporated is a fast-growing technology company in the southeastern part of the United States. The company is publicly held, but Ivan Johnson and his sons control 55% of the stock. Ivan Johnson is chairman and board of the CEO. He personally makes all major decisions with little consultation with the board of directors. Most of the directors, however, are either a member of the Johnson family or a longstanding friend. The board basically rubber stamps Ivan Johnson's decisions. What does that term rubber stamped mean? Means they approve it without ever thinking about it, without ever reviewing it. They basically say, okay, Ivan said it, that's fine. Okay, we'll accept that. All right. So let's talk about this. What do we think about inherent risk? There's a little bit of information given about inherent risk here. What was the kind of the clue about the inherent risk, the nature of inherent risk in this particular problem? Publicly traded, fast growing, publicly traded company. Yeah. So yeah, probably high level inherent risk when we talk about this. All right. Now, if we have high inherent risk, we're going to assume high inherent risk. I think that that's probably a good assumption given that it's fast growing and it's publicly traded. What would be the important thing to have in a publicly traded company? Good controls. What do we think about the controls just based on this depiction right here? The nature of controls in place here. I would make an argument there are not good controls in place, or at least if the controls are in place, they're being ignored. So how would we characterize that as an auditor? Would we say control risk is low, medium, or high? I'd say high. Okay. This is probably the highest control risk that we could take a look at because basically controls, if they are in place, they're not effective because Ivan Johnson basically makes his decisions. Okay. So he just makes his own decisions and does what he wants. And that's just kind of the worst bypassing controls that we could see. So inherent risk high, control risk high, risk and material misstatement is, yes, high. We're going to say it's high. All right. Maxi Wright Corporation is one of the several companies engaged in the manufacture of high-speed, high-capacity data storage devices. The industry is very competitive and subject to quick changes in technology. Maxi Wright's operating results have placed the company in the second quartile in terms of profitability and financial position. The company is not the leader in industry, and the products lacked its performance levels of the industry leader. All right, how would we characterize inherent risk for this particular company right here? It sounds high to me. Okay, they're in a highly competitive industry. They are not the company leader. It sounds like they have a risk of becoming obsolete at any moment. So everything here seems to be pointing to the fact that inherent risk is really high. But if everything here is pointing at inherent risk, what is not being discussed in this particular scenario? Control risk. Do they have any information really about controls in this particular scenario? Not to my understanding. Okay. So let's talk about this. And we're going to go back to something I skipped on part A, but we'll do that as part of part B here in just a second. So let's say that you go and talk to the managers of MaxiRite and say, you guys have got kind of a really, really rough time in the industry. You know, there's a chance that you go and undergo technological obsolescence. You are subject to a ridiculous amount of risk. And they say, you're absolutely right. That's why we take our controls very seriously. We've got properly designed controls. They're operating effectively and we test them consistently. Here, you can look at them and use the auditor, go in and test the controls and say, wow, these are really good controls. These are some of the best controls I've ever seen. Is that a possibility? Is it a possibility they could have an incredibly high inherent risk, but they have just incredible controls to address those inherent risks? Certainly, okay. In that scenario, what would we say control risk is? Say control risk is low, okay. So could we say risk and material misstatement is low if control risk is low? Remember that diagram that I showed you guys with Irving and Craig and that said that we dictate risk and material misstatement by whatever the lowest is. If controls are great, they have addressed the problem of their inherent risk in their organization. And so we can say risk and material misstatement is low. All right, let's change the scenario. We go to the client, we say, you know what, you got a lot of risk subject to you. What are you doing to address these problems? Say, you know what, we haven't really thought about it. We've just been too busy trying to keep pace with the rest of the industry. So you go and you look at the controls and they've got some controls, but they're really, really slipshod and haphazard. And a lot of them are not operating effectively. Okay. What's your assessment of control risk in that scenario? High. Control risk is high. So that means inherent risk is high, control risk is high. And then that means risk and material misstatement is high. So let's talk about those scenarios because we've talked about two scenarios. One, where we said risk and material misstatement is high. That was the first scenario, and that was that scenario we talked about. So assuming risk and material misstatement is high, either that you go into Johnson Incorporated and you say, man, this place sucks, okay? And or you go into MaxiRite and say, yeah, they just don't have good controls to address their inherent risk. Either scenario, you walk in and you say risk and material misstatement is high, okay? What does that mean about detection risk? What are you going to set detection risk at? Low, because remember, detection risk is inversely related to risk and material misstatement. Is that a good thing or a bad thing? Detection risk being low is a bad thing because remember, that's our tolerance. That's our appetite for risk. If we can't tolerate very much risk, what does that mean about the level of work we have to do subsequently? A lot more work that we have to perform, okay? Now, scenario of MaxiRite, where I say they've got great controls. Risk and material misstatement is low. So that means detection risk is high. Detection risk is high. Do we like high detection risk? Yes. Normally, as auditors, we say we don't like high risk. But remember, detection risk is an appetite for risk. We can tolerate more risk, means that we can do less work. Okay. We can find smaller, we don't have to test to find small errors. We can actually have higher errors and still be okay with that. All right. So less work is good for you guys. Okay. And I think we all came to the conclusion that we're all happy with less work. We're all happy with less work. So that's why we want to have high detection risk. First National Bank of Pond City has been your client for the past 2 years. During that period, you have had numerous arguments with the president and controller over a number of accounting issues. The major issue related to the bank's reserve for loan losses and the value of collateral. The prior audits have indicated that a significant adjustment is required each year to the loan loss reserves. Now, we have to do a lot of assumptions in this particular scenario, but I think we can work through these together, all right? What would you characterize the inherent risk based on just this simple, silly little narrative, this just minor narrative here? I would say probably high. It's unlikely that you're going to have problems in trying to estimate loan loss reserves in an industry where there's not a whole lot of inherent risk. Seems like the nature of this industry creates some controversial financial decisions that are going to be subject to scrutiny. All right. Now, this one's a little bit of a stretch, but what about control risk? Can we determine anything about control risk from this narrative? So what are controls designed to do? Controls are designed to mitigate risk. If we have good controls in place at a client, how frequently are misstatements going to occur? Hopefully never, okay? Hopefully never. Have we seen significant misstatements for this particular client? Yes, they actually said that we had to make adjustments in previous years. So that probably indicates the controls are not doing their job. The controls are not mitigating this misstatement, all right? Not creating issues or not creating proper loan loss reserves. So I'd say inherent risk is high, control risk is high, meaning that we probably are going to set detection risk at high, Dr. Barnes. High, Dr. Sorry. Low. We're going to set detection risk at low, meaning that the amount of work we have to do is going to be a lot later on because we're not really trusting this company. Their management seems to be really problematic and really adversarial. By the way, there's a possibility that we could just say, you know what, this client is too much for me. I don't want to have to do anything to do with it. We're just going to leave the engagement. Is that possible that we could have that scenario? Is there excessive engagement risk with this particular organization? We talked about engagement risk on Monday. We talked about it and said, this is something that we're worried about the subject to our reputation of litigation. Would this be a client that you would concern yourself with? I mean, it looks like they're trying to get away with accounting shenanigans, and if they are caught and it's turned to be fraudulent, would we as the auditors be held liable for that? Possibly, okay? So this might be a scenario where we say, all right, after this year, we're done with this client. We don't want to have anything to do with them. And I'm not going to say that's 100% going to happen, but out of the 3 clients, it'd be the most likely scenario where I'd say this is a contentious relationship. This is a problem. All right, moving on. All right, we are moving on to my favorite case to talk about in this entire course, Cost Corporation. So Cost Corporation, is anybody familiar with the goingconcern.com blog, the web blog, accounting blog? If you've never explored that before, I'm going to tell you right now, do it now before you go into public accounting, because if you do it when you're in public accounting, your superiors will frown at you. It is a very good resource for accounting information, but it is a little bit irreverent, okay? And by irreverent, I mean they use naughty words, all right? So if you're okay with that, then it's a pretty good website. I was a really big advocate for this back in the 2009s, 2010s when I was leaving KPMG, and I read it continuously. I still check it occasionally, although I haven't been up to date to it recently. But one of their big ones around 2009, 2010 was this particular case right here, all right, the Cost Corporation, maker of headphones that had this massive fraud. Now, what was the nature of the fraud that was going on here? Was it a financial statement fraud? No, it was a misappropriation of assets fraud, which is kind of what's unique about it, all right? We are actually going to review this case again, so get comfortable with this case because we're going to see it again when we get to controls testing in Chapter 6. This is actually our case that we're going to be discussing. Now, there's going to be more information in Chapter 6 that will add on to this, but this is a two-parter. So today we're going to talk about the nature of this case. So some stuff going on here. Sue Sagdeva was the vice president of finance, and she was sentenced to 11 years in prison for embezzling $34 million from the company. All right. So just a quick guess. She did this fraud over a 7-year period. Anybody want to guess how much in net income costs had during that same 7-year period? Give me a number. $10, 100 billion, somewhere in the middle. Somewhere in the middle? It was $70 million. Do the math on that. Susak Davis stole 50% of the net income of this company over a 7-year period. Okay, that's on one hand, you're just kind of like, wow, that's ridiculous. On the other hand, you're just kind of like, good job. Wow, I can't believe you got away with that. That's amazing. Yeah. So yeah. She returns Canada. She was a shopaholic. Actually, if you do with a little bit of delving in the literature, I don't want to make fun of mental illness. That's not my intention. But I will say there's an interesting thing that came up is that she claimed to be suffering from bipolar disorder, which is certainly an issue. But she didn't treat this in kind of a rational way. She did shopping sprees. That was her way of dealing when she was depressed. She went on shopping sprees. She didn't actually want any of the things she purchased. She never kept most of the merchandise she purchased. She would actually bring it to her with the office the following Monday and would sell it to her coworkers. So yeah, that's kind of crazy. Just kind of like when you go shopping, you don't actually want the merchandise. You just want to buy stuff. You just want to buy stuff, which I don't personally understand that. Usually it's hard for me to go to the grocery store. I was like, oh, I got to waste my time doing this again. Some people are just kind of like, yeah, just go out and buy stuff. But yeah, Cost Corporation had to restate its financials. So she basically embezzled to what was said to fund a lavish lifestyle, which had a vacation ownership interest in Hawaii, Mercedes-Benz, and other automobiles. Paid for luxury travel, and neighbors said that they had packages that were sometimes 6 feet high, large household staff. These were well beyond her salary, which is $175,000, which is a pretty good salary. I'm going to tell you guys, if you become managers or partners in an accounting firm, and I hope that you have that level of success and you get that $175,000 salary, it is not enough to fund a household staff. Okay, so stop looking at it like that. Okay, you're going to have a lot more success than just being a manager or partner in an accounting firm to start funding household staff. And I know your thought is, Dr. Barnes, I watched the Brady Bunch when I was younger, okay, and they had Alice in there, and that guy was just an architect, and so how hard can it be? Is it, well, sometimes TV does not depict reality. All right, I don't know if you feel that. Even reality TV shows don't necessarily depict reality. Yeah. So basically she said she explained her lifestyle by saying her husband earned a couple $1 million a year and they both came from wealthy families, which is convenient. Okay, that's very convenient. So the misappropriation was ultimately discovered by American Express. Notice, not the auditors. Okay, not the auditors here. Basically, she was making cashier payments to Neiman Marcus and Saks Fifth Avenue by using SFA Inc. and MN Inc. for that. Able to conceal the fraud by directing other cost employees to make numerous fraudulent entries in the books. Julie Mulvaney, company senior accountant, is responsible for making the journal entries, reconciling accounts receivable, reconciling the bank statement, ordering cash checks, prosecuted wire transfers, checking the Bailey to account balance, assisted ACCT data, and covering up the fraud. So Julia Mulvaney, she's gonna come up again when we talk about this in chapter 6. But basically, Sue Sackdeva had an accomplice here. I don't know what the nature of their relationship is, but it sure sounds like that Julie was kind of like just trying to do something nice for a friend, and Sue kind of abused that privilege kind of frequently. That's the way that I interpret it based on all my readings. All right, here's the fun stuff. So other information about the company. Michael Koss simultaneously held 5 senior management positions: vice chairman, chief executive, chief operating officer, president, and chief financial officer. Can you believe that in a public company? This guy must be like a finance Superman. Is that the conclusion we're coming to? Is like this guy's finance Superman? Yeah, yeah. Is that what it's like? All right. What else does it say? Koss had little or no educational background or experience in areas of accounting or finance. Okay. Well, all right. That's I guess that defeats that purpose. All right. So yeah, allegedly delegated important responsibilities typically performed by CFO to Sackdeva on a regular basis. Okay. So let's just go ahead and give the fox the keys of the hen house. That's the analogy there. So the fraudster is committing the fraud. Say, you know what? I don't want to do this work. I've got a tee time on the golf course. So can you please take over all these responsibility areas for me? It's like, yeah, sure, no problem. Sue was probably there in college when her professor was talking about segregation of duties and knows that if she has all 3 areas of functional responsibility, she can commit fraud. And so she figured that one out. Okay. Smart person. And Michael Koss did not know about segregation of duties, did not know the importance of segregation of duties. That will come up again. All right. Cost did not have an internal audit function. That probably would have been something to help. Control environment appears to have been remarkably relaxed. And so control environment, we've heard that term before. We're going to hear it again. Remember, that's in the COSO framework. What does the control environment say? It says, how seriously does the organization take controls? If it says remarkably relaxed, is that a good thing for an organization? I mean, it's like controls, whatever. We've got them somewhere. They're lying in the corner, I think, over there. Yeah, that's certainly a problem. Corporate board rarely changed, excluding a member out in 2006 and founder John Koss. Board members had an average tenure of 27 years. All right, I'm not trying to dispute that board members can be experienced and still be there for a long time. But in all likelihood, how much expertise do you think they have on financial reporting or modern trends if they've been on the board for 27 years? Okay, what do we say about the nature of audit committees? They have to contain at least one, what was that term? Financial expert, very good. Okay. What is the reason for that? Is because we want to have somebody who knows what's going on in the organization. There's actually a book that I have my senior seminar and auditing students read, and I've had several students read past. It's called Bad Blood. It's about the Theranos saga. And one thing that was very characteristic of Theranos is they had an incredible board of directors. They were all incredible dignitaries like Henry Kissinger and I'm blanking on some of this, like General, what his name was. There was a former general of the United States, United States Army. There was some other people who served on the U.S. cabinet post. They had all these incredible people with these renowned reputations. You know what they didn't have? Somebody who knew about blood testing, was the industry they're in. So that's kind of an example of, you do need to keep in mind the composition of the board of directors and those charged with governance is a really important detail. All right. Unlike the proxy statements typical of public companies, Koss made no mention of any accounting expertise among the audit committee members. Ooh, that's a bit of a problem, especially in the PCOB era. Because it was a small company, cost was not subject to the to a section of the Sarbanes-Oxley Act that required outside auditors to evaluate a company's internal controls or financial reporting. So specifically, SOX 404 is applicable to public companies. At this time, it was public companies with over $75 million in revenue annually. I believe recently that was upgraded to $100 million in revenue annually. I believe that's the current threshold. But costs fell below that range, so they did not have to do internal controls testing under SOX 404. And we're going to talk a little bit about that and the nature of that. But the idea being is that they did not have required auditor testing of internal controls. Why is that so important? Remember the analogy we talked about back in chapter 1, and I said we need to know the process by which results are achieved and not just the results themselves. Okay, that's the cheeseburger that gets sneezed on over at Seabreeze. That's the example. Okay, so they didn't know anything about what was going on internally. They just knew what the end result is, which is problematic. All right. During the embezzlement, the cost of audit fees were reduced by half, by 114,900 in 2007 to 63,600 in 2008. By the way, this was not uncommon during this period. That was the global financial crisis. I was working during that period. Audit firms got their fees reduced pretty substantially. All of the bells and whistles that got added to audits, a lot of those got cut out. It was a very interesting time because in 2007, my busy season, I was averaging about 70 hours a week. 2008, my busy season, I was averaging 40 hours a week, which was very, very, I was kind of happy because I actually got to see the sunshine, but it also affected my chargeability pretty thoroughly. So yeah, that was not uncommon. But what does that mean? What does that detail? Why is that so important? Well, if you're getting less money, that means that you can pay fewer workers to do the job, or you have fewer hours available to you. So you're probably not nearly as thorough in the audit if your audit fees get cut in half. In 2006, David co-chaired a fundraising gala for Big Brothers and Big Sisters. One of the costs is outside auditors. We're going to talk a little bit about the nature of independence. This is not necessarily a violation of independence, but it is a concern because it seems that there may not be an arm's distance relationship, an arm's length relationship between the auditors and at least SACDAVA, if not costs themselves. All right. So assume you're a member of the audit team, identify the fraud risk factors for misappropriation as the president for cost corporation. So we got that triangle, okay? Got that triangle. Pressure, opportunity, rationalization. All right. What would be some obvious pressures that were identified in this case? SACDAVA is a shopaholic, okay? She maintained a large household staff. She was really big on luxury. She basically wanted to keep up a wealthy lifestyle. I think those are all kind of representative pressures there, okay? Any others that you identified? Some pretty easy ones, pretty straightforward ones, okay? Now, let's jump to rationalization because I think the rationalization's a little bit more transparent, but I do want to talk about opportunity, okay? So that's the easier one. All right, rationalization, all right? Now you could kind of go into this like shopping makes me feel better, being a shopaholic. That's one rationalization. What is another possibility, a little bit more relevant to the actual work that she did at Koss herself? Whose work was she doing? Well, obviously her own work, but anybody else's? Michael Koss's, okay? Now think about this. Let's say some of you go onto the graduate program and you become my GTRA, all right? And you kind of find out that I don't actually do any work myself. All my GTRA does all my work, okay? So you're getting paid a GTRA salary. I'm getting paid a faculty staff salary, but who's doing all the work? You are, okay? By the way, that's not true. I do quite a bit of work on my own, okay? Maybe not as much as Dr. Caden, but I'm not a psycho, all right? So yeah, so you're doing all the work. Don't you deserve that pay? Don't you deserve that pay if you're the one doing all the work? It's okay, you can nod. I'm not going to grade you on this, okay? Yeah, that's an easy rationalization, okay? If you have to do all the work, you have to actually get that pay. I would say that probably something Zach Davis said. Yeah, I got Michael Koss is always on the golf course. He's never doing any of the work. He doesn't know anything about what's going on. I deserve his salary. I deserve it. I've earned it, okay? What about the opportunities? That could also be kind of construed as an opportunity, is the fact that she had all this power. She had the power of 5 different executive positions. That's like in cartoons, that's like Voltron or something like that, isn't it? You know, that would be the most boring cartoon ever. We 5 executives form this power. Anyway, yeah. So yeah, 5 executive positions. So she basically could bypass any controls that were present pretty easily. Okay. Any other opportunities that we could see? So something about internal audit. Their internal audit function was non-existent. Dr. Barnes, it was non-existent. They didn't have internal audit function. Is that an opportunity? Can you commit fraud when people aren't watching what you're doing? Yes. What about the external auditors? The external auditors were there, right? barely. Okay. External auditors were kind of like, okay, we're doing our hard work. We're cutting your fees. We're not doing much work at all anymore. All right. What about the oversight governance? Governance is supposed to have good oversight of what's going on. Okay. So they at least had a board of directors who was overseeing things. Oh, the board of directors was a bunch, for lack of a better term, a bunch of old men. They were a committee of Dr. Barneses. Yeah. So yeah, a whole bunch of people on there that were just had no idea what was going on and just kind of like saying, okay, things look good. Things look good. I don't know why we made $70 million, but it's only 35 is showing up on the income statement, but whatever, things look good. Audit committee. They had an audit committee. Is there any problem with the audit committee? No financial expertise on the audit committee? Yeah, certainly problematic. Yeah. Obviously, these are cherry picked, but these are all pretty obvious visual examples. Bottom line here, yeah, certainly some fraud risk factors we could detail. Now, we've already talked about this, but let's go ahead and just drive it home. Is it appropriate for one individual to hold 5 significant senior management positions all at the same time in a publicly traded company? All right. I'm not even gonna have you raise your hands because if anybody raises yes, I'm gonna have to throw something or says yes, I'm gonna throw something at you. So the answer is no, but why? And if we think about this, first of all, it's probably too much responsibility for one person to bear, and they can't effectively do their job in that area. But from a opportunity standpoint, there's a much simpler explanation that's very relevant to us. That's the CAR, custody authorization recording. The reason that we separate out responsibilities in an organization is if one person has too much responsibility, they can get away with actions that they wouldn't be able to ordinarily get away with. That was one of the big drivers of this particular fraud is that Susak Deva had all of these responsibilities. She didn't have to ask permission from anybody. She could just go and do something and take the money on her own. And as we're going to see moving forward, even that can be problematic if we start talking about further concerns. But for right now, we're going to say Susak Deva was a problem. Cost didn't recognize it was a problem. It was only the heroes of our story. The auditors, I mean, American Express, who came in and finally solved the problem. Okay, but we're gonna revisit Sue again after the exam. So we'll go ahead and put a pin in that for now and move on. All right. So now we're doing some risk assessments. All right. So I'm not going to go through everything in detail here, but I do want to talk about what you find. I want to make a note of this, that this is not necessarily an easy task, and it's not made easier by the fact that we're doing this from McGraw-Hill, because there's some materials that I think would be present here, be easier to be present here, but it's a little bit more difficult to dig into. But hopefully you found information that could identify this, or identify the nature here. So I think the first two questions are pretty straightforward. What are the major sources of revenue? And they said basically their major source of revenue is going to be their sales to their clients. Now, they talked about in the annual report, which by the way, I did make a note of that your annual report is in the end of chapter 1. So hopefully you identified that. They talked about their source of revenue and who they were selling to. So I don't talk about their database, but where was that? Yeah, 86% of sales were direct and 14% from retail. This is an important point to make. Why is that it's so important that we note that 86% were direct and 14% were retail? Well, the answer to that goes back to something we talked about in materiality. Remember I talked about how accounts receivable is not a critical account? Does everybody remember that? I was saying, yeah, accounts receivable, not that important. And I said, the reason why is this is not traditionally a business-to-business environment. So business to business, you actually do business with other organizations, other companies just like you. This is more of a business to customer environment. You sell directly to the customers. 86% of their sales are to the customers, meaning that they're probably not extending a lot of credit to retail operations. Some, 14%, which is not an inconsiderable amount, but not a significant amount, not like most of the operations of the organization. All right, so that one's probably not a whole lot of risk when we talk about that. Nature of the key customers. So I talk about the nature of customers here. And so 2021, average annual household income of 104,000, average age of the customer is 45, which I will say, given the number of LL Bean catalogs I've seen in my life, that was probably about the time that my dad started guiding the LL Bean catalogs at home. It's like saying, okay, this is where I want to start exploring the great outdoors after I've gone through my midlife crisis, okay? By that logic, I should be getting LL Bean catalogs at my house by now, but I've somehow managed to avoid that trend, okay? And I said, well, Dr. Barnes, you're much older than 45, so it works out. It's like, yeah, okay, thanks. Dagger to the heart, guys. All right, so let's go ahead and move on to the key suppliers. There was some information about the key suppliers in here that was very, very relevant, okay? So two pieces of information, all right? So How many suppliers? 300 domestic and foreign manufacturers. That's what I say here. All right. So is that a good diversity of suppliers that's in place? I'd say so. Is there a caveat to that, though? There's a very definite caveat to that. Otherwise, I wouldn't have stopped and asked if there was a caveat. Okay. Generally, I don't ask questions where the answer is no. All right. All right. So what does it say after that? One manufacturer and one intermediary accounted for 14 and 29% of the company's received merchandise. So that's what 43% of all merchandise comes from two sources. Is that a risk that needs to be addressed? That's a really big risk. If one of those organizations goes out of business, or God forbid, both of those organizations can't be reached, then that's a significant chunk of their business operations that have suddenly halted. So as an auditor, this is where we would say, all right, this is a risk. There need to be appropriate controls identified to address this risk. What would be a control in this area? There needs to be ties made to other suppliers so that in case there's a dropout of one of these particular key suppliers, that another supplier can come in and take their place, provide similar merchandise at a similar cost. So that'd be the first thing. That'd be the first one. There's also another one in the next paragraph. If you go down here, what's here? Where was it? Oh, it's in the same paragraph. What I say? All right. About 80% of the company's merchandise was imported. Okay, mainly from Asia, Central America, Mexico, and Central America again. So apparently double Central America. That typo's been there forever. Anyway, so Asia, Central America, and Mexico. So is that a risk? Certainly, because we don't have a lot of domestic manufacturing. So if we have imports changes come up, like for example, this current administration is going to be increasing tariffs. Just for context, tariffs are not going to be a imposition on the companies that are going to be in the other countries, but the people who are buying in the United States will be imposed on those tariffs if they buy from those other countries. That might make it less attractive to purchase from Asia, Central America, and Mexico if you're earthware clothiers, if you're going to be subject to tariffs. So that's something to be concerned about. All right, so certainly risks there. Major assets of the major assets of the company. All right, I just gave up one of the major assets. What's the primary asset we think is here? The one that's constantly flowing and changing, and it doesn't have the highest balance, but it's the one that has most activity. I said inv, and I was kind of giving it up. Inventory, yeah, inventory. They're a retail inventory sales company, so they're going to be like that. What will probably be one of the other the organizations? So they actually need space to store this inventory. So what's going to be one of their other big asset accounts? Yeah, PP&E. Okay, they don't do a lot of personal manufacturing, but definitely the storage and the supply chain management associated with movement of inventory is going to be a complete concern, which is going to contribute to PP&E. Is there any intellectual property that we should be concerned about in this area? Yeah, customer database. Yeah, customer database is going to be a good one. So that one's kind of an ancillary one, but even though it's not considered to be a tangible asset, it would still be something that would be very relevant and have value there. Major liabilities. Did anybody notice anything about their liabilities here? Did somebody look at this point and say, okay, what are their liabilities? How much long-term debt do they have? They have zero long-term debt, which is kind of a neat position they have. They do have a line of credit, which is worth noting, but no long-term debt. All right. Competitive industry environment present any risk to the company? What do you guys think? Do they have competition in their industry? They've got a highly competitive industry, and I think that probably what it says in here is probably understated. I don't think that they go in depth as much as the competitive competition. This is a case that again was made in the early 2000s, late 90s, early 2000s, before e-commerce really took off. I would say e-commerce is certainly understated in this particular case and would be a big risk area. So this is one of those ones where you're trying to identify any risk remaining. I'd be saying, yes, there are risks remaining here. We'd want to make sure that they have addressed the particular problems with additional competitors that can easily enter the industry and create volatility and fluctuation. Customer dynamics, do they present any risk for the entity? I'd say probably no with this particular one, simply because we know what the nature of the customers are. Those are not fluctuating. Those are not changing. They're pretty stable and pretty consistent. Technological factors presenting a risk for the entity. This one's a pretty subjective one. If you answered yes or no, both of those could be right. You could say, yes, they had an AIS issue in the prior year, okay, which may reflect on the current year, but they've made assurances that the AIS issue has been resolved and it's been operating for 2 quarters without any concern. So if you answered yes, that's fine. If you answered no, that's justifiable too. Okay. Last one. Is there high turnover seen in your management of the board? No, there's not high turnover, but is there anything that we need to make a note of here? Yeah, Brad Norton. There was turnover a key executive, and it's not so much that Brad Norton left as he left without any expectation or really any explanation, and was replaced by Carol McKay. Now, what do we know about Carol McKay? She's probably well-meaning, but is she qualified for her position? No, we've already established that. That was something we were concerned about with respect to engagement and acceptance. Does that represent a risk? Could there be misstatements? Could there be failures and controls in the areas where Carol McKay has oversight? Yes, there certainly could be. So that'd be the concern areas here. So let's go ahead and solidify what we think, okay? If we're going to talk about the areas that we think the most risk exists or there's risks that are remaining, I would say certainly we need to know about the key suppliers. The key suppliers have multiple risks associated with them. And so even though we know what the suppliers are, they probably need to implement a little bit stronger controls in those areas. Other ones, competitive industry and their risks. We think I said like I thought that those were understated, particularly with respect to e-commerce. Those probably need to be addressed and make sure we have proper controls there. And even though it's not necessarily relevant to high turnover, okay, we do have a risk associated with the turnover of a specific executive simply because their replacement does not appear to be qualified for that position. And that could lead to material misstatements or control deficiencies in the future. So those are the three areas that I would expect you to note in a scenario like this, is that there are a lot of information here, and we could say there's risk present in all of those. I would say that Earthware Clothiers has done a good job of addressing risk for most of these scenarios, for most of these areas. The ones that I would be really, really concerned about as an auditor still would be suppliers, the nature of the industry, and the executive that we pointed out. If you identified that, great. If you didn't, that's cool too. We now know, and as they used to say on the G.I. Joe cartoons, knowing is half the battle. So yeah. And with that, we're going to call it a day. Have a good weekend. I'll see you on Monday for Chapter 5. Chapter 5 will be a ride for sure.